Good morning, and thank you for joining us for Reuveni Reel Talk. This is our first bi-monthly video supplement to our Reuveni in Real Time weekly report. For those of you who are not familiar with our reports, I urge you to look us up and subscribe. Our weekly reports are a summary of all new transactions in Manhattan up to 125th Street. We track and compare each week's data with the week of March 9th to the 15th, which we consider to be the last normal week of business pre-COVID-19. We also make a comparison with the same week last year. Our data is carefully collected and dissected daily. We do not rely on hearsay in our reporting. Rather, to assure accuracy, we use information from two reliable sources to verify each entry and transaction. We are a privately held company. Our data is unbiased. It is prepared and presented solely for the purpose of providing true in real-time information to our industry, brokers and colleagues, to our clients, and to their capital partners. Our bi-monthly video sessions are 20 minutes long. We'll try to stick to that. It will be impossible to cover every aspect of the market within this limited time. So to be efficient, we focus on the most notable transactions and trends within a given 2-week period. With me is TJ Quinn, our Director of New Development and Research. TJ generates our reports and is involved with pre-development, design, and management of our projects. Trust me when I tell you, you're in the virtual presence of a human encyclopedia. So let's get right to it. These past 2 weeks showed 348 new contracts signed in Manhattan. That is a very strong post-pandemic performance. And also given that we're between two major holidays. TJ, how do the past 2 weeks compare with the same time last year and with the last normal week of pre-COVID in March 2020?
So first of all, Shlomi, thank you for the introduction and thanks to everyone for joining us today. So, if you look at what happened 2 weeks ago, wasn't much to write home about, to be honest with you. We were looking at about 152 transactions, which was light compared to what we'd seen throughout most of November, where we were pushing roughly 200 transactions a week. I think 2 weeks ago, people were probably still coming back from Thanksgiving. Things were a little slow. And that number from 2 weeks ago, it was about 30% less than where we were, when COVID started, but only about 7% less compared to this time last year. What's more interesting to me from 2 weeks ago than the number of transactions was the dollar volume of those transactions, which was about 336 million, which is actually about flat with where we were at the beginning of COVID and where we were at this time last year. So you think, okay, fewer transactions, but about the same, if not more dollar volume. What's going on there? When you look at the numbers, it does look like this, 2 weeks ago was a little more top heavy compared to this time last year. There were more trades over 5 million. There was one trade over 20 million versus this time last year where there were none. So interesting to see that trend. It's only a week's worth of data, so I wouldn't make too much of it, but interesting nonetheless. And then when you look at this past week, that was particularly strong. Almost 200 signed contracts last week, close to $400 million in dollar volume. On the surface, very strong week. But that's on the surface. If you look at it a little bit more, there are a few buildings in there that, a few new development buildings that may have been holding signed contracts in their back pocket and only released them last week, which may have propped up last week's numbers a little bit. We'll get into that a little bit more. But I do think that, may have contributed to the strength of last week. Nevertheless, it's great to see these numbers in a post-COVID marketplace.
So that's pretty incredible. You mentioned close to $400 million in sales this past week. It was very close to that the week before. So the total sales volume in the past few weeks really has been very impressively high. And this is due to higher number of deals at price points above $5 million. It's very telling of a very specific demographic of affluent buyers, the majority of whom are local families with strong ties and commitment to New York, and who have not been financially impacted by COVID-19 in a negative way. In fact, probably thrived. Wall Street has been very kind to a lot of people in the past few months. Most of these buyers have been sitting on the sidelines in the past few years, but now we see them transact. And in most cases, they're negotiating very aggressive deals. TJ, while the top of the market is obviously very active, do you think this is an indication of the overall health of the market?
I'd love to say that it is. I don't know. But I don't know that it is, to be honest with you. I think there are a few, very special projects that have been really kind of propping up the market over the last few weeks. We'll get into those a little bit more later, but I think that's more of what we're seeing recently versus, an actual trend, but time will tell.
Right. So let's not forget, right? It's very sexy to talk about high-end deals. Everybody, I mean, I know I wait for Donna Ocean's report every Monday, right? For it to come out and see what transactions, occurred the previous week over $4 million. But 85 to 90% of all transactions are under 3 million. That's an incredible number. 75% of all transactions are under 2 million, and approximately 50% of all transactions are under $1 million, right? That sector of the market, under $3 million, is really the bulk and meat of what the market is. TJ, what are your thoughts about the activity in that market sector? And how does it compare, that market sector, how does that specifically compare to what we saw at the same time around 2019?
So look, I mean, it's great to see, right? This has definitely been a segment of the market that has been strong, more so than the uber luxury end, has been strong for the last few years. And, you would think that segment may have taken more of a hit after COVID. But it's interesting that it hasn't. If you look at, both the number of transactions and the dollar volume, under 3 million, now versus this time last year, it's roughly flat. It's roughly the same. So why is that? You had the tax changes in 2019, which almost would have certainly impacted that buyer a little bit more. You have COVID, which again, presumably would have impacted that buyer a little bit more, but it doesn't seem to have really happened yet. So to me, the reason for that, at least one of the reasons, it's got to be interest rates. Today's $2 million buyer might have only been able to buy $1 million last year. Yesterday's $2 million buyer might have only, could probably buy $3 million today. So interest rates have got to be driving that segment of the market.
Yeah, it's interest rates, and for sure it's negotiability. I think the writing is on the wall. It has been for a long time. I think transactions occur when there's a level of negotiability. And things are definitely much more negotiable today than they were in the past. I think owners are much more willing to transact, and that's why we're seeing more transactions. But a few things that are interesting to note: the percentage of resale transactions over $5 million is relatively low. It's approximately 5 to 10% of resale transactions above $5 million. If you compare that to new developments, over 30% of the deals in new developments right now are over $5 million. So it's just interesting to do that comparison in terms of price points between resales and new developments. A couple of other just things to note: 65% of all deals that we're seeing are in co-ops. 30% of all deals right now, on or about, are in condos. About 5% of all transactions are in townhomes, though this past week we only saw one townhome transact, which is a little unusual. New development transactions only represent about 8% of all transactions, which is relatively low. TJ, you touched on this before. This week we had a spike in the number of new development transactions. We had 29 deals versus last week's 12 deals. You see a reason for that?
I do. Last week, roughly 14% or so of the total transactions were from new development projects, which is, notably higher. And I do think there's a reason for that. I alluded to this earlier. There are a few projects, 130 William Street in Fidei, 695 First Avenue in Midtown East, that have been selling, since 2018, and didn't release any contract signed for quite a while. And then recently, we've started to see deals from both of those projects start to trickle on the market. This is a strategy that some projects have. They wait until they hit a certain critical mass to tell the world how they're doing. And I think that might have been a little bit of what was going on last week, and which, could help explain, the spike in new development trades last week versus what we typically see.
Right. So it's while we do all this, right, we scrutinize numbers on a weekly basis, on a bi-weekly basis, on a monthly basis. It's also very good not to react or not to have a knee-jerk reaction to every number that comes out, because you really got to look at the whole thing within the full context of a quarter and then a year. You're right. Some of these contracts might have been signed 6 or 9 months ago, or maybe even before COVID. And the fact that they all come out now might create the impression of very strong activity. While it's true that there are signed contracts, it may not necessarily represent in real time. Let's talk about inventory. What are the inventory numbers showing when we look at today's active on-market listings versus last year at the same time?
Sure. So but before I get into that, just for context for our audience here. So when COVID hit and the marketplace kind of fell off a cliff, inventory went down to just over about 6,000 units on the open market, right? We're not talking about shadow inventory here. And then over the spring and summer, we did start to see that number slowly increase. We started to see it accelerate even more. I think after New York City surpassed the phase 2 reopening. So July, August, we really started to see that number grow up to, 10,500, 10,600 units on the open market, which is around where the market was, during Lehman times, just for context. Then we started to see within the last month or so, I want to say, that number start to dwindle. There was, I think, a lot of, kind of irrational exuberance maybe in the market after phase 2. Which informed that increase that I just mentioned. And then between that, I think starting to fade away and us getting into the holidays, I think that's why we're starting to see that number go down to the point now where, as of last week, we got under 10,000 units on the open market for the first time since September. And then again this week, that number went down even more. So it's promising to see. Inventory is definitely headed in the right direction. But I think it's important to note that it's not there yet. This time last year, we were at about 7,300 units on the open market. So not really where the marketplace needs to be in terms of achieving, the right equilibrium, but we're headed in the right direction. And let's just hope it continues that way.
Yeah, I agree. I think the trend so far is looking good in the past few weeks. But yeah, there are concerns about the level of inventory. If you look at last year, you just said 7,300 units in December 2019. It's 9,700 units now. That's about 25% more inventory this time. Now, there's definitely the concept of shadow inventory, right? I mean, this does not take into consideration new developments that have inventory that is not formally listed. Also, like you mentioned, towards the end of the year, most sellers may not list right now and just wait until first quarter of 2021, especially now with the positive news of vaccine and the elections sort of behind us. There might be renewed energy into 2021, and that probably is going to follow with more listings. It will be interesting to track and to see what the first quarter of 2021 looks like in terms of inventory. And hopefully that will also be supported or followed up with absorption. So let's talk about some notable deals that we saw this past couple of weeks. And what's been most impressive to me is the Upper East Side. For months since the beginning of COVID in March, we saw very quiet activity on the Upper East Side. While certain other submarkets in the city might have been doing well, the Upper East Side was very quiet. But in the past few weeks, we've been seeing some very strong activity, and I wonder why and whether this is a trend to last. The recent new activity is at higher numbers, mostly in condos and mostly new developments. One of the projects that I see that is doing really well right now, at least showing more activity, is 301 East 80th Street, Bigfoot Tower, where the developer is Icon. While their transactions are not showing on Street Easy, it's rumored to have sold numerous units in the past few weeks, about $5 million. It's a beautiful building, beautiful design, very gracious layouts, good ceiling heights. Location is interesting for these price points. The units are relatively large and over $2,500 a foot. But still, they've been able to put some transactions in place over $5 million, which is very impressive for that part of town. Another big transaction this past week is 1228 Madison Avenue. CBSK is the developer. Reportedly, they sold a penthouse, which is a combination of the top duplex plus a floor below it, total of 6,150 square feet, and reportedly in contract for $27,850,000. That's $4,500 a foot. That is stunning to me within the context of COVID, market conditions, and the fact that the building is a land lease. I think we have seen some successful examples of new lease land lease projects, but let me ask you, this is a real impressive transaction, right, for a land lease. Are there comps for this, or do you think buyers just see this as a condo proposition, given the location, the design concept, the unit mix, and the fact that this is, I heard that this is a 150-year lease, which probably would make a difference as well.
Right. So, there are certainly co-ops, maybe along Fifth Avenue that have, transacted around this price point. It doesn't mean that they're necessarily ground leases, though. So I can't think of, of a ground lease example recently that comes close to this $27 million mark. I think it's important for the audience to know that, not all ground leases are created equal. Some of them are structured in a more straightforward way. Some of them, are structured in a little more of a complicated way, with much less certainty to them. I can only assume that the ground lease at 1228 Madison is structured in more of a straightforward way. And the fact that there's 150 years to it, reportedly, versus some other ground leases that might be closer to 99 years, that could possibly be helping buyers get their heads around this as well. So I think definitely you can only assume that the length of the ground lease and the way that it's structured is a positive thing here. But also I think it really comes down to the location. This is really prime Upper East Side. We're talking Madison Avenue along between 89th and 90th, I believe. And if history tells us anything, ground leases become less of an issue the more prime your location is, right? You look at 995 Fifth, the Extel building from back in the day, 10 Bond Street, in NoHo that came out, I think maybe 2014, 2015, 252 East 57th Street, Worldwide's project from a few years ago. All of these were ground leases, but all ended up getting numbers that, were not that far off from straight condos close by. Why? Because they were either in great locations, or they delivered, great product, or all the above. And that's exactly what's happening at 1228. So I can only assume that between the way the ground lease is structured and the fact that this is a super prime location is contributing to them being able to reach this, such incredible price point so far.
Right. And I think while the market is challenging right now, that specific sector, that specific demographic of buyer, this is exactly the kind of product that they're looking for and will pay a premium for, even in a market like today. Another example of a very impressive project is Mickey Naftali's at the Benson, 1045 Madison Avenue. I mean, this one really knocks it out of the park. They've reported a few transactions, the penthouse at $35 million, and then a few other transactions between $14 and $22 million. That to me is incredible in today's market. And my question is this, given the context of the building, the design, the location, the unit mix, which I think was very smart, would have been very easy for a developer to make a decision about a unit mix that's less risky. Smaller apartments, more transient apartments at a lower price point. But they went all out in terms of the unit mix and in terms of the size of the units, and they really designed this for a very specific clientele that is currently the clientele in the marketplace in terms of paying a premium. But let me ask you, while we're seeing some improved conditions on the Upper East Side, do you think the Benson is an outlier in today's market?
I do, I do. And while we have seen, consistently, big transactions there, over the last few weeks. I do think it's important for the audience to know that, we don't necessarily know if in fact those transactions happen in the last few weeks. The offering plan there was approved at the end of March. We know that they've been quietly selling there since September. So, these units could have actually, gone into contract over the summer or earlier in the fall. We don't know yet, but nevertheless, whether it was March, whether it was September, or whether it was now, all those dates are after COVID, which to me is very, very impressive to be able to achieve, this level of success given everything that's going on around us. And the reason for that is because of just how special this building is. I believe it's, I think, the first ground up building along Madison Avenue in about 20 years. And what's interesting is that even though, $3,700 a foot might seem like, an unachievable number in today's marketplace, which, by the way, 3,700 is about the average for the 15 apartments there. I actually think there's value to that. If you look at the few projects that propped up along the Madison Avenue corridor at the height of the last cycle, 2014, 2015, they were closer to 4,000 a foot. And those were all conversions. Some of them had, stabilized components still in the building. Some of them, like the Carlton House, had 8.5 foot ceilings. And again, those were all pushing 4,000 a foot. So to get into brand new product with a super high level of design by Peter Prenoyer, who, to me is one of the greatest architects that we have today, for only $3,700 a foot, there's value there. And I think the buyers that are signing contracts at this building today, they recognize that. They recognize how special this opportunity is, and that it might not come around again for a long time.
Yeah, I completely agree. Kudos to Mickey Naftali and his team, and I'm confident that they're gonna do very well with this building. Let's touch on a couple of other submarkets in the city that are doing well and interesting, notable transactions. The West Village obviously is doing really well. We'll get much more into detail with the West Village in the next conversation. We have a project there, 90 Morton, that's been very successful in the past few months with numerous sales above $10 million and incredible demand in that submarket. There's a strong trend there for trophy townhouses as well. But like I said, we'll get into that in our next session. Upper West Side is interesting. We saw a couple of notable transactions there. The new project by Centurion at 212 West 72nd Street just showed the first sale on the 19th floor, 2,200 square feet at $6.5 million, which translates to about $3,000 a foot. I think that's pretty incredible for that intersection. And a really interesting first transaction. We'll see what happens with the rest of the building. 350 West 51st Street, DNA's project. Nice guys, by the way, Alex and David, great guys at DNA, great developers. They sold their penthouse that's about 2,300 square feet with a 1,200 square foot terrace for about $5 million. That's $2,200 a foot. This is for a low-rise off West End Avenue with not a lot of amenities, and that's a big number. So that's a great transaction. In Nomad, we're seeing some really interesting transactions. 277 Fifth Avenue, beautiful building by the Victor Group, excellent developer. They put something in contract on a 48th floor that's about 2,000 square feet for close to $7 million. That's $3,500 a foot. That is incredible. That's a huge transaction, and kudos to that building. That's a beautiful building that really deserves it. 15 East 38th Street, Madison House, on a 52nd floor, put an apartment in contract for $7.2 million. That's $3,000 a foot. That's great activity for that submarket. We're marketing 30 East 31st Street, and we've seen a flurry of activity and offers since we reduced prices, which again, that submarket is just very, very active and very strong right now. Midtown West is interesting. 157 West 57th Street, Extel's project. There was a resale this past 2 weeks for $22.5 million listed, which is $5,000 a foot. Now, I have to assume that this was heavily negotiated. And my question is, there's still sponsor units left in that building. This is a resale. We'll see where the number ends, but I'm sure it's below the remaining inventory Schedule A pricing. And 157 is not alone in that situation. There are plenty of projects in the city where the developer still has sponsor sales, sponsor units that have not sold, and is now competing with resale transactions where there's no control over pricing and possibly are selling for substantially less. What do you do as a developer in this condition? How do you compete? And what does that say about value in the building?
Yeah, I mean, it's a tough thing to deal with for sure, because when you see resales like that are trading for substantially less than, the remaining sponsor inventory, it has to kind of, unfortunately, cannibalize the remaining sponsor inventory, I do think it's worth noting, though, that with 157, there have been a few trades, resale trades, at much lower numbers that were more a function of the buyer's own financial issues than the building itself. The tough part is explaining that to a buyer, because when a buyer sees these sort of trades, they don't really care what the circumstances are. They're just going to compare whatever they offer to that. So, having that conversation, with the buyer is a difficult thing. That's going to come down to the quality of the broker, probably at the end of the day. But I do think it's worth noting, at least at 157, a few of these depressed sales were more a function of the buyer's own issues than what was going on in the building.
Absolutely. And the issue is that banks and buyers and brokers alike look at it as a comp, and that could affect value in the building. There is something to say to the fact that a brand new apartment is a brand new apartment that's never been lived in before. It does make a big difference, and it should carry a premium. But you're right, it's up to the broker to explain it. Now, down the block from that is something that was just reported by the Wall Street Journal, not verified yet by Street Easy or OLR. 111 West 57th Street, Michael Stern's project, reported sale of $50 million. That is incredible. Not unbelievable, but still incredible within the context of this market. What do you make of it? $50 million on West 57th Street.
Yeah, I mean, look, an incredible feat, no doubt, COVID or not. And I think you're absolutely right. There's something to be said about brand new product. If you just compare it to the unit at 157 that we were just discussing, the buyer that just, bought that, they'll be the third buyer to set foot in that apartment, and it's been, roughly 9 years since the initial sponsor sale. So there's got to be some wear and tear in that apartment at this point. Versus the trade you just mentioned at 111 West 57th, which is pretty comparable in terms of size and views, but it's a sponsor sale. So it's the first time somebody's going to be setting foot in that apartment, which obviously carries a premium. And then with 111 specifically, I think it's worth noting that building, as opposed to everything else along Billionaires Row, falls smack dab in the middle of Central Park. So for that buyer out there that, absolutely has to have that in their portfolio, knowing that it'll never come around again, they're still gonna jump on it, COVID or not. And I think, a great example of that is this trade that we just saw at 111 for $50 million.
Yeah, so that's an incredible sale, possibly the last big one to end 2020, and on such a great note. So congratulations to everybody involved with that sale. This is it for us, pretty much, for this first session. Thank you very much, everybody, for joining us today for Reuveni Reel Talk. I hope you found our discussion informative. We welcome your input, suggestions, questions, and comments. Please follow us on social media and subscribe to our YouTube channel and to our weekly in real time report. Our next in real time report will come out in the first week of January 2021, and our next Real Talk video discussion will take place on January 6, 2021. Be sure to join us. In the meantime, and until then, I wish you and loved ones a very happy holiday season and much health and happiness in the new year. Stay safe and be well.